Well, good morning, everyone. Thomas Montgomery. It's a beautiful Wednesday morning. Today is January 22nd, 2025. We get together most weekday mornings at 8 o'clock Central with our distribution partners to talk about strategies, tips, techniques, share success stories, and support each of you. We have two types of distribution partners. We have those of you that are resellers, and this is the support Zoom for our resellers. There's no cost to become a reseller. If you want to become a reseller, there's information right here to email us a request. We'll send you the packet. No price to pay, no contract to sign. You're in if you request to be a reseller. Our second type of distribution partners are our Shelf Corp stores. These are the professionals that are actually opening up brick and mortar offices to help improve financial literacy and increase access to capital in their communities. We have a different training set for a different training Zoom for our Shelf Corp stores. So with that being said, today's January 22nd. We're having our reseller training. As I mentioned before we start, if you have any questions, comments, concerns, type those into the Q&A. Our agenda is threefold. We're going to talk about QuickCash. Then we're going to answer any of your questions. And then what are we going to do? What do we say every day? We should leave today's training and go apply what we've learned to make money. If not, why are you here? So you're welcome to be here to listen in, but we encourage you to take this knowledge, these resources, these ideas, these concepts, and go monetize them for your benefit. At the bottom of the page, as usual, we have our resources. If you want QuickCash yourself, as stated on the bottom of the flyer, you'll go to 509 Pacific, real easy to get right there. If you want to become a reseller, here you are. If you want to speak to someone, call Madison. Want to access any past trainings. But let's get into QuickCash. Now, so QuickCash is an alternative and or a complement to the Shelf Corps. So our primary resource that we provide through our 501c3 nonprofit are fundable Shelf Corps. And you can go back to past trainings and get the full spiel on it. But at its essence, there are a lot of entrepreneurs, small business owners who need money to start or grow a business. I think that's a fact. The problem is most of them do not qualify for funding. In our words, our vernacular, they don't have a fundable business. Worse yet, a lot of these folks, they don't know what you and I know. They don't even know what it takes to have a fundable business. So there's a gap in knowledge and a gap in preparedness. You and I, through our reseller program, can go help these individuals have a fundable business in a week. We can go to funding in a week. So that's the Shelf Corp. That's not what we're talking about today, but I bring it up just because within the Shelf Corp is QuickCash. Maybe that's not been apparent enough. So this is where we transfer 100,000 of QuickCash to anyone that gets a Shelf Corp from us. We also offer QuickCash as a standalone, and that's sometimes what we think about. But the QuickCash standalone is a portfolio, in other words, an amount of 10,000, which clearly stated right here on the top of the flyer. We provide 100,000 of QuickCash with the Shelf Corp. So it's included for free with the Shelf Corp. If someone doesn't want a Shelf Corp or doesn't need a Shelf Corp, they can get QuickCash individually. So I know I didn't do a good job yet of describing what QuickCash is. I'm going to get to that. But first, I wanted to let you know that we essentially deliver QuickCash to the market two different ways. They can either buy a portfolio through QuickCash standalone, or they can get it free through the Shelf Corp. Now, we have some people that get free through the Shelf Corp, but they need more. So before I dig into how QuickCash helps you and I and helps our clients, I want to pause for a moment and validate the model. So in business, often it's not always having to come up with a new invention. It sometimes is taking something that exists and either packaging or marketing it differently and then being able to help more people. And so that certainly is the case here. So did we pioneer this concept of QuickCash? We did not. We did not. Can't take credit for it. So, in fact, one of the biggest players, and I'm giving you very transparent information, so you could go work with them if you'd rather work with them instead of us. But I believe, to my knowledge, the largest, or at least one of the largest players in this space is called Encore Capital Group, Inc., out of California, if I recall correctly. This is no small firm. Their annual gross revenue is over 1 billion, 1 billion with a B. Their average net income is 75 million, and this is a publicly traded firm. So what do we know about publicly traded businesses? Publicly traded businesses are highly monitored, scrutinized, and regulated. If you're going to do something that's shady, you don't do it through a publicly traded firm because you'll get caught and you'll go to jail. So what does Encore Capital do? They are a debt buyer. So let's go ahead and add that. So I'm going to give you some terms, some vocabulary that maybe, I don't think it'll make you feel uncomfortable. Just you might say, I'm not familiar with it, but that's why we're having this discussion. So you could, if you were to say, well, what does Encore Capital do? They are a debt buyer. So they buy debt. Now, when they're buying debt, they might go to, let's say, Capital One, and they might buy $10 million of defaulted credit card agreements. So, in other words, people that had a Capital One credit card didn't pay for it, they went into default, Capital One couldn't collect. So, what happens? So, they sell it for pennies on the dollar to companies like Encore Capital. So what does Encore Capital do? They pay pennies on the dollar for it, and then they turn around and collect that money, and they make a ton of profit. And they're regulated, publicly traded. So this is a way that companies like Encore Capital can get assets. So let's create a little vocabulary list here. So we just discussed debt buyer. So a debt buyer is a person or organization that buys typically defaulted non-performing debt instruments with the intent to collect, and they make money off the profit. And that makes sense, right? You could move it away from defaulted debt instruments and just think about real estate. If you saw a house for sale down the street from you and it was selling for 5 cents on the dollar, maybe at a tax county sale, would you buy it? Well, you might, because it's a great deal. You're paying 5 cents on the dollar. Let's say the house is worth 100,000 and you bought it for 5,000. Is that a good deal? Oh yeah, it's a great deal. You're paying pennies on the dollar for that asset. Now, just because you buy that house, does that instantly make money? No, it's an asset, but now we're going to need to monetize it, which either means we flip it, we turn around and sell it for a profit, or we put a renter in and start collecting money off of it. That's how assets work. Assets are something that people, and I guess we should add that to the vocabulary. Assets are typically objects or things that people or organizations buy that have value, that typically have an income potential, either by generating cash flow or growing in value. So that's what wealthy people do. Wealthy people have assets. Wealthy people focus on accumulating assets. Often poor people spend the money that they have on expenses, where wealthy people spend as much money as they can on assets, which increases their net worth. So there's different types of assets, right? So we could buy real estate, we could buy stocks or bonds, you could argue crypto, even automobiles. Now, automobiles typically will depreciate, but there's some collector cars and some cars that grow in value. So what we're talking about here that Encore is buying is they're buying assets. And what are we doing with QuickCash or with the Shelf Corp? We are providing assets. Now, what's interesting is we don't sell the assets. Because of the grant we received, we give the assets away. So when someone comes and gets QuickCash, and you can see it on 509 Pacific, we do not charge them for the 10,000 in assets. We literally give it away because of the grant. When people get a shelf corp, we don't sell them $100,000 of assets. We give it away because of the grant that our 501c3 received. So now we're on to something, right? Okay, so this is a way that you and I can help people that have an inadequate amount of assets. Well, why does assets matter? If the goal is to help a client get funding, a business loan, for example, to start or grow a business, most lenders care about collateral. Remember earlier this week, we talked about the 3 C's, and we can add that. So we have the 3 C's for funding, and that's credit, collateral, and capacity. So we're talking about collateral. So does collateral matter if we're trying to get a business loan? It does, because it's what protects the lender. Typically, lenders want to loan money to borrowers, to people or organizations that have at least enough collateral to match what the loan amount is to provide the lender protection in case the borrower doesn't repay. So that's why when we designed the shelf corp, we built in the 100,000 of collateral, because a lot of clients we work with aren't like you. A lot of clients that come to us, they don't have enough collateral. So they want a bigger loan, but they don't have collateral. So we provide the collateral for free, because when we designed this, we knew that it would likely be an issue for most people, and it is. So that's how QuickCash is built into the shelf corp. The reason is to provide collateral. It's even labeled that. Now with QuickCash, QuickCash is a standalone. So people can come to us and get QuickCash without desiring to start or grow a business. QuickCash is just the assets. It doesn't include an entity or EIN. It doesn't include business plans. It's just the assets. But let's go back and talk about another important vocabulary term, which is liquidation. So just like we said, if you saw a house for sale down the street from you and it sold for $5,000, but it was worth $100,000 and you bought it, great. So now you spent $5,000, but you're better off for it. It's worth more than you paid for it. It was a good deal, right? It was a good deal. Same with a car. If you saw a car for sale and it's worth $10,000, but someone didn't know any better or needed money quickly and they sold it to you for $500, is that a great deal? Sure, it's a great deal. So when we're accumulating assets, the asset needs to be monetized. It needs to make us money. Otherwise, it's just kind of an expense. If we bought that house for $5,000, great deal. But if we don't flip it and sell it or move a renter in, then we're not making any money from it. It's still an asset, but it's not making money. So when we provide the QuickCash, whether it be 10,000 in QuickCash alone or 100,000 over in the shelf corp, typically, and it's up to the client, but typically we're going to liquidate it. So different assets are liquidated differently, but what it means in terms of debts, AR, accounts receivables, is we want to collect the debt, collect the AR. I've had enough conversations with some of you. I realize respectfully, some of you don't know what AR is. So AR stands for accounts receivables. And it's a very common term in business. The example I give that no one likes is, let's say you and I go mow Miss Betty's yard. She's gone to church. We mow her yard. Of course, we wouldn't be mowing a yard in January, but regardless of the date discrepancy. So we mow Miss Betty's yard. She's gone to church. So we put a note on her door. Miss Betty, thanks for letting us mow your yard. Pay us $20. So that's an accounts receivable. It's monies that's owed. Some people operate on a very simple concept. And so they think, well, if I didn't mow Miss Betty's yard, then I'm not owed $20. But what do really smart people do? And I think you and I are some of those smart people. We don't have to go mow people's yards. We can instead go get that invoice for the people that did mow the yard. We have a bill of sale, so now it's our invoice, and Miss Betty owes us. So that's what's happening with in a 10,000 increment on QuickCash or a 100,000 increment for the Shelf Corp is we are getting someone else's AR. Now it's owed to us, so we want to collect it. Well, why would we want to collect money owed to us? Well, that's the silliest question in the world, right? Why wouldn't you want to collect money owed to you? That's what a responsible business would do. If you're owed money, AR is an asset, that's fine, but what would we rather have than AR? We'd rather have the cash. So it's an intermediate step. So a fair number of people come to us for QuickCash for a couple different reasons. And so let's go ahead and talk about uses of QuickCash. And again, if you have any questions, comments, concerns, feel free to type it in and we'll get to it. So one of the primary uses for QuickCash is it provides money for people who can't get a loan. And that's actually right down here. Who do we help with QuickCash? Don't qualify for a loan. Because if we were to go get a $10,000 loan, that would be even more direct, wouldn't it? Right? We would go apply for a $10,000 loan. We would get approved. Typically, the money's wired into our account. Now we have 10,000. Well, that makes sense. But not everyone's as fortunate as you are. So some people can't get approved for a $10,000 loan. So what we do is we add an intermediate step. We transfer the assets to them, which we don't charge. Remember, through the grant, we're giving away the 10,000. Keep that in mind. We are not selling this 10,000 worth of assets. We're giving it away. So with QuickCash, the first use is people that can't qualify for a loan. We can do the asset transfer. Then we can liquidate it and turn it into cash. So they end up getting the cash, but there is an extra step. Another frequent use of QuickCash is people who do not want to borrow money. So you and I are sophisticated enough to understand that if we go borrow 10,000, what's the bank going to expect? The bank's going to expect that we pay it back, typically principal plus interest. We're going to have payments, right? Because that's what loans are, meant to be repaid. With QuickCash, there's nothing that has to be repaid. So that's a significant advantage. Some people use it to buy a Shelf Corp. So now we're kind of merging the two. So while QuickCash is standalone, the Shelf Corp is sold for an amount that you determine. If you're a reseller, which we encourage you to be, you determine how much you want to sell the Shelf Corp for. I think the average seems to be 20,000. I used to say a different amount, I know, but from ongoing conversations with you, I think most of you are selling the Shelf Corps for 20,000. Clients don't have to pay anything down, which is great. So it's zero out of pocket. So as a reseller, you get a client under contract to buy a Shelf Corp. You pick the sales price. We'll use 20,000, but it's up to you. So then we would go get them financing to pay you for the $20,000 purchase. Well, let's go back to the agenda. What happens if they can't get a loan? Then they could use QuickCash instead of getting a loan to buy the Shelf Corp. So do people have to use the money from QuickCash to buy a Shelf Corp? No, it's their money. And I've had that asked, I think, 2 or 3 times yesterday, which kind of was the stimulus for the catalyst for today's call. The QuickCash is your money or the client's money. Whatever they want to use it for, they can. All right, so let me pause for a moment. I'll put some spaces in here so it's just easier to read. Let's get into the questions, comments, concerns that you have. Okay, so Carl's asking about the liquidation, and that's a good point. So we've had a separate training where I went through great detail of how we liquidate it, how successful it is, how it works. So rather than spend 30 minutes going through that, Carl or anyone else, you can go to our YouTube channel. And I think the title of that training was Liquidation, if I recall. It was a couple weeks ago. And that'll give you great detail because I sometimes I'm hesitant to answer some of your questions just because of time constraints. So, but in summary, Carl and everyone else, when we liquidate it, it means we're going to collect the AR for you. Now, Carl's question is there a cost for liquidation? There is. There is a cost for us to liquidate the AR. Now, let's talk about the cost. Let's add another vocabulary word and we'll talk about, I guess, compliance. So we are licensed, bonded, and insured to collect the money. So when we help clients with QuickCash or the full 100,000 over in the Shelf Corp, and yes, I see some of you asking, can you get more than one QuickCash? Sure, you can get multiple. Lots of people. We had Donna yesterday, I think, bought 5 QuickCash yesterday. But so sure, you could have more than one Shelf Corp, you could have more than one QuickCash, but that doesn't change. It's still in 10,000 increments. So we're licensed, bonded, and insured to collect the money, to liquidate the AR. So we'll take care of that for our clients. And that's what's turning it from AR into cash. Because we can use the AR right away. So from the moment someone gets QuickCash or gets the Shelf Corp with 100,000, we can put that on their balance sheet. We can put that on their personal financial statement. Now they have the collateral, which was one of the 3 C's. But then as a subsequent step, it just makes sense to liquidate it, which means to collect it. And we do that for our clients. So let's talk about the dollars and cents. I think that's what I see Darius is on here, and I think that's what Darius is asking. So let's even add it, and let's just be completely transparent. Liquidation cost. So the way that we built the model to be really great for our clients is we pass the liquidation cost to the debtor. All right. So there's the debt buyer up here, and you're considered, or the debt buyer is considered the creditor, if I can spell correctly. So the person that's owed the money, doesn't owe the money, it's owed to them. So we'll further define the recipient. The person that gets the money is the debt buyer, also called the creditor. But there's another party involved, right? So when Encore Capital goes and buys $1 million portfolio from Capital One, that was the example we used, then Encore is the debt buyer. They're owed the money. They're going to receive the money. That's where all that money comes from. But there's also a debtor. So a debtor is person or business who owes the money. So there's 2 people in the transaction, person that gets the money, your client, the person that owes the money, the debtor. So with the liquidation cost, we have an innovative model. So does it cost us to collect the money? Of course. But who pays for that? The debtor does. So we add the collection and legal fees on top of the principal amount. So the debtor pays us to perform the liquidation services. One note, though, is that there are some hard costs. So the hard cost would be the court filing fees. So just to summarize, with liquidation, again, we have another training, encourage you to go see it. You can see it here. But what we're going to do is we're going to start by, in summary, don't take this as the full story. I'm referring you back to the full training, but I'm going to give you the 1-minute overview of how we liquidate and why it works so well. So first we have a real debt. There's a real debtor. We will do a skip trace search. So we'll make sure we have their current address. We'll search the social security number database and make sure we have the right SSN and date of birth. Then we're going to send a letter to them that is a demand letter, and we're going to email them an invoice. So two things are happening. They're going to get an invoice to know, to put them on alert that they owe the money. They're going to get a letter. So following federal laws, the Fair Credit Reporting Act, then we have to give them a bit of time to respond. Only about 2 to 4% of the people respond. Almost no one responds. And then if they don't respond, which is called a validation, then that debt is locked in, it's theirs. Now, even if they do dispute it, like you hear about credit repair, our program is credit repair proof. There's never, ever going to be an instance where the debtor can make this come off their credit through credit repair, because we've learned that system, and we won't lose that. So then it'll go on the debtor's credit. So first we'll let them know that there are consequences of not paying and encourage them to pay. So real nice and friendly. They owe it. It's not like we're being mean. They owe you, or they owe the client the money. Demand letter request it, lets them know if they don't pay, it's going to go on their credit, and we're going to sue them, and we may pursue criminal charges. I'll give you an example of that in a moment. So then usually people will pay or make payments. If they don't, they'll go on their credit. Then usually people will pay. If not, then we're going to sue them. Usually people will pay. If not, then we're going to look at criminal charges. And we have a client in Hope, Arkansas, that we were able to get put into county jail for theft of property for not paying. So a lot of people think, oh, if you don't pay, there's really no consequences. Depending upon the circumstances, they could go to jail. And that's a system that we leverage. So there is a hard cost for liquidating. So our labor is free. We do have to collect, and we just call it a simple processing fee. So we give away the 10,000 cash, QuickCash. Client receives it within 24 hours. Then we liquidate it, and then the client gets the money. All right, so let's get back to your questions. That was a good question that you had there. Let's see, Todd's got the next. So Todd's asking about the liquidation, which is good. That's what I was highlighted. So when we are in a compliant way collecting the money from the debtor, they may either pay in full or they may need to make payments. And so if they need to make payments, so have it. If they pay in full, that's even better. But Todd, you're asking for more of a yes or no answer, but the question is, it depends on the debtor. Let's say that the client, the debtor owes your, we'll just say you to make it simple. So let's say the debtor owes you $10,000. So the debtor comes back and says, I don't have 10,000, I have 6,000. We accept that. And so we'd come back to you and say, okay, Corinthian, your debtor doesn't have 10,000, debtor's offering to pay 6,000 today, take it or leave it. And so then the client, in this case Corinthian, can say, yeah, 6,000 is a great deal, right? I get 10,000 for free, and she turned it into 6,000. That's a hell of a deal, right? What's the ROI on that? It's like infinitely high, because she paid nothing for the assets, and now she's getting 6,000. So you're right. It may be that the debtor makes an offer for a reduced amount, which we'll come back to you to see if that's acceptable, or they may need to make payments. Yeah, it's too good to be true to think everyone will just whip out and pay the full 10,000. Okay, who has other questions, comments, concerns? All right, Franz is asking about our success rate, so that's a good one. So let's add that. And we'll call it our anticipated collection percentage. And we anticipate collecting between 82% and 84% of the face value of the debt. So I never want you to think it's too good to be true, because that's where, it's not credible. So if someone were to buy QuickCash, would we go after all 10,000 through the liquidation? Absolutely. But in every case, will we get all 10,000 back from the debtor? No. In some cases, we will. In some cases, we'll get a lesser amount, just like we said a moment ago. Maybe they offer a settlement, and if you agree or your client agrees to that, then it's a settlement. But on average, we would expect to collect 82 to 84%. So if you do the math, it's still not bad, right? So someone comes and gets QuickCash. We don't charge them anything for the assets because of the grant. So they're getting 10,000 in assets for free. We turn that into, we'll just round that off and say we turn that into 8,000 in their pocket. Is that a good deal? Hell yeah, it's a good deal. I mean, where could you go get stocks for free and then watch it grow and make you money? Where could you get real estate for free and watch it make you money? Normally, assets have to be purchased. Because of the grant, we're giving it away. So we're giving away in 100,000 increments, or through QuickCash, 10,000 increments. All right, so we're about to run out of time. Who else has questions? Okay, so Rachel has a question on the QuickCash. So one of the important things to consider, Rachel, is so QuickCash is typically one debt instrument worth $10,000. In other words, one debtor that owes 10,000. And normally with the shelf court, normally it's 10 debtors that owe 10,000, which adds up to the 100,000. So you're right, you can game the system a little bit, Rachel. So someone could come get a shelf corp and get the collateral for free in 100,000 increments, or they could get standalone QuickCash because they either can't afford a shelf corp or they don't want everything else. They can get it standalone. And again, to get QuickCash, just go to 509pacific.org. It's at the top of the page. But yeah, to Rachel's point, she's right. And it causes some confusion. So fundable shelf corp, is it the way to go? Hell yeah, it's the way to go, because you get all these free resources, plus you get $100,000 of QuickCash, right? So it's great. But Rachel's question is a little deeper. Well, when do people get all of these deliverables? Well, they get it once they have paid you for the shelf corp. So they need to pay for the shelf corp. It's like if you go to a furniture store and say, hey, I like that couch. When do you get to take that couch home? When you paid for it. So when do your clients get all of the deliverables of the shelf corp? When they pay for it. Do they have to pay anything out of pocket? No, there's zero out of pocket. You'll get them under contract. You should have an editable client agreement. You get them under contract. Then we send them a finance app and we finance 100% of that. It's great. So again, if you need QuickCash, go to 509 Pacific. If you're not a reseller and want to make money helping people, just send us an email. We'll send you the packet. It didn't cost you a penny. If you need to talk to someone, call Madison. And if any of this you need a little deeper understanding, then feel free to go to our library, we call it. Essentially, it's our YouTube channel, and you can dig deeper on QuickCash, on shelf corps, on liquidation, or anything else. All right, so sorry we ran long. We'll be back same time tomorrow morning. Let us know if you need anything. Have a great day. Bye-bye.